All right, folks, welcome back. This is our commentary for Tuesday, January 11th, 2022. All right, so we have dollar still maintaining its consolidation on the daily chart. We had a Fed chairman testifying today at 10 o'clock, which caused a little bit of movement. With that, it looks like we're probably going to drop down into this area in here. Okay, it just looks like it's a little too heavy. You might want to trade down in there. Then if it gets a little overzealous and goes below that, comes back up and finds resistance there, that could send this into this area here. Overall, that would not technically break the long-term trend, but it would be a little bit more deeper of a retracement than I would have rather seen. But it's January, so I'm not doing anything anyway. So observation, collect intel, and we'll see what we get. Dollar index hourly chart. We have a balanced price range in here. Market traded up into that after dropping initially. Traded up into that. And at 10 o'clock, Fed Chair Powell spoke and caused the market to seek an old low. Didn't quite get down below that yet, but certainly looks like it wants to try to do so. Watch this order block, fair value gap, and or this area in here. Again here, 10 o'clock, Powell testified, broke down that old imbalance I gave you yesterday. All I did was extend it out in time. Again, you can see the balanced price range here on the 15-minute time frame. Dropped down first, rallied up, pumped it ahead of the Fed chairman testifying into the balanced price range here. Trades into it and hits like a brick wall and goes lower. Institutional order flow entry drill here. Sells off for one more 15 pip or so decline. Euro dollar daily chart. Again, this thing sideways. I do think it will probably try to expand up into this area here tomorrow. We have CPI number. I failed to mention that earlier when we were talking about the dollar. So 8:30 tomorrow, high impact CPI number. Then we have a FOMC speaker at 10, and then crude oil inventories at 10:30. So that way you guys can monitor those reports and volatility injections. All right, here's the euro dollar hourly chart. Last down close candle here and balanced price range right in here. And we trade down into it. Order block, balanced price range. And then right here is the 10 o'clock hour where Chairman Powell, jawbones, and central banks use that to send price higher. Relative equal highs, buy side liquidity, attack that. 15-minute time frame, euro dollar. Again, that hourly order block. Trades down, hits it. Powell testimony, sends it higher. And one more stab above, getting into almost the 113.80 institutional level. But overall, I would not have been a participant in this if it was like another month. Daily chart. Pound dollar. Finally, we get into that bearish order block. So we pumped up into that. So honestly, I don't know if it wants to continue because, I'm sitting on my hands. I'm watching. I'm observing. I'm trying not to have too much of a bias, too much of an opinion. But continuation takes us up into here. Okay, so I don't see it reversing. So we'll see if it wants to trade up into this fair value gap, buy side liquidity. Okay, and again, nothing in here terribly exciting except for the Powell testimony that the banks used for smoke screen today in the 15-minute time frame again. Nothing down here I like to warrant this turn here. So it's just, again, price action that would not have me participating in. And that's why I've been noting on the forum, do not engage. Nothing right now is making any sense. So because it's not making sense algorithmically, don't touch it. Just sit still. You have the month of January I've already told you about. Now we also have price action that is not symmetrical. Just leave it alone. Observe. I know it's frustrating for some of you to just want to be doing something or feel like you can trade in it. Don't. You're just asking for probabilities to chip away at your bottom line and drawdown. And taking more losing trades in is necessary. So again, listen, that's what you're paying for, mentorship, right? So I'm mentoring you to sit still. The logic is wait. Wait until we get through January. Let them iron out all the holiday kinks and hopefully stimulate some kind of a sentiment. All right, it brings us to the indices. Now I went right to the 5-minute chart just to save a lot of time. You guys can look at your other time frames and break that down if you want. 8:30 in the morning, 11 o'clock in the morning, that's our operating hours for the morning session for indices. Take a look at the lows in here. We have a low, and the E-mini S&P and the Dow futures. This is being plotted with the compare tab. If you look at TradingView, somewhere in this vicinity above here, you'll see the little plus symbol and the word compare. You click on that and you add the symbols you see here and here, and you click it as a new pane. So that way it plots it below the NQ H2022, which is the NASDAQ March futures delivery contract. And I'm plotting this. If you put your cursor around in this area here, click it, and then go to the little gear, change it to plotting on the lows for both Dow and the E-mini S&P, and you'll see the S&P divergence. It's here. Okay, NASDAQ failed to go lower, while the E-mini S&P went lower, the Dow went lower, and at the same time we had Powell speaking, and we had a break in market structure, swing high being broken there. We trade back down in for a retracement, and then off the races we go, seeking buy-side liquidity. So, again, consolidation in the afternoon. All the fireworks was around the Powell testimony and set the stage for that intraday rally and retracement. All right, that brings us to our discussion today and lecture on visualization of trade framework. This is the second of 5. So I'm giving you kind of like a snapshot of what internally you should see as a viable setup. Now, it's not limited to this. Okay, I could literally frame, I don't even know how many I could probably go for months. You know, if I did one every single day, I could still outline how the things that you learn from core content and how to read price action, all the various ways of setting up a potential framework for a trade. And while they all do not form every single day, the understanding of what you're looking at creates a well-roundedness and a complete understanding of how price action can deliver based on scenarios that are like this. Now, a pattern like this probably won't form more than maybe once a month, and it may not form in the asset class that you're following. It may be in a commodity, it may be in a stock, it may be in some other asset, but the understanding of how price is likely to deliver with these signatures tends to repeat when it forms similar to this. And right away you should see this looks just pretty much like the fair value gap that we're looking for a premium array that we're reaching up into. I just changed in the volume imbalance. Okay, so just like yesterday's example, if that was a volume imbalance instead of a fair value gap, the same logic would still be there. Okay, so the draw is this on the daily chart. That's what we're representing here with this crude diagram. So these are representing individual daily candles. So we're seeing institutional order flow that's bullish. Something down here, higher time frames, sets the stage for bullishness, and we don't need this high to be taken out. It may not even be a swing high. It may be part of a more longer term decline that took place. But just for the sake of visualizing what constitutes a setup that's viable and PD arrays that may be available to you, this here, volume imbalance, there's no bodies in between this candle's open and this candle's close. We have wicks in there that do touch, but there's no representation of high volume that would be seen with the bodies of the candles. Okay, so we had a short-term low form, market trades down, fills in a fair value gap. Does it send price higher? Yes. And then we have an outside day. Okay, so an outside day, I taught this also in commentaries. The outside day is any day that has a high that's higher than the previous day's high and lower than the previous day's low. So it's the opposite of what I showed you yesterday when it came to an inside day. But the central tenet to this is the outside day must be a down close. Okay, so what that does, it creates a short-term oversold condition. And I just added a bullish order block in here just for the sake of adding one more thing to it. It doesn't need to have that. But an outside day with a down close, when you're bullish and you have a draw on liquidity that's above the marketplace, okay, you want to find a old daily high or previous daily high prior to the outside day. Now you can't use this one because it's less than the day that you're using to frame the trade idea. Okay, so this day opens above, trades down, and closes on the low, or closes down from the opening. So the outside day is with a down close. That sets up a short-term oversold condition while bullish, and we're looking for higher prices. The first target or scaling would be the previous daily high here prior to this day forming. So obviously you can't trade this day, it's the next trading day. Okay, so for instance, if this was a Monday that it created the outside day, you'd be taking the trade on Tuesday and or Wednesday. Tuesday and or Wednesday would be expected to see higher prices. The probability is really high that the very next day after a down close outside day, when it's bullish, that it's going to create the rally the very next day. Typically, that's what you'll see. But again, like with an inside day I taught yesterday, it could be the very next day. And again, if it does not rally after the second day, I do nothing. I do not consider the trade. I wait because it could be consolidating or may even retrace. Okay, so first target is previous daily high prior to the outside day. In other words, a short-term old high. I don't want you thinking previous daily high. What, how about this one? Well, you're trying to buy it, so why would this be a target, right? So this would be the first scaling or first partial, and then you would be looking for the discount low of the daily volume imbalance, consequent encroachment, midpoint in between, the premium high. That's the best case scenario. Okay, so here's your four targets, and in here I don't try to do something at every one of these levels. Also, I got an email about that. Do I always try to take a partial at the discount low, the consequent encroachment, and the best case scenario? No. The best case scenario is there just to get that last little piece, and it's such an insignificant amount of position left on at that time. It doesn't make a difference if it hits it or not. It's more or less just for a moral victory. I'm typically aiming for consequent encroachment, and the majority will come off at the discount low. Okay, and obviously everything would be reversed if I was bearish and I was using all the framework that's being outlined here from when it's bullish. We would be just reversing it for when it's bearish. All right, so intraday, we would be looking at a 15-minute time frame, and this level here represents this candle, an old swing high or an old daily high prior to the outside day forming. So that would be your first target, and the outside day's high and low would be here, and you would start the next day, preferably slightly above the outside day's low. Judas swing may form, and when you see a London rally, then a retracement down into New York. Optimal trade entry, preferably with a fair value gap. If you don't see it in this leg from here in London up to the short-term high prior to the 7 o'clock to 10 o'clock New York open kill zone, or the 8:30 to 11 time frame, this high in that low, if you break it down to a 5-minute chart, like I mentioned last night, you may see another short-term swing low in here. You would use that to this high here, and then it would most likely give you a fair value gap and optimal trade entry there. And also notice that it's taking out some form of sell side liquidity. So maybe the day prior to the outside day, we have this day here, it may have had relative equal lows, and it's smashed down below that and closed below it here. So sell side's taken out, it's short-term oversold. Retail would see that as extremely bearish, while the context is bullish, and we look for the market to try to reach up into this area here. So that's what we're seeing. Then the next day here, assuming that the outside day was a Monday, Tuesday and or Wednesday, we would expect London to create some kind of a rally, retrace down into New York, setting up an optimal trade entry with a fair value gap preferably. And then we would look for that to be a long entry, taking out the high of the outside day, and then accelerating, like I mentioned yesterday with the inside day example. We would expect to see a lot of momentum and speed at that point, reaching for an old high. That would be your first partial. And then holding for time of day between 10 o'clock and noon for London close for a time target, but overlapping with the daily volume imbalance, which is represented over here in the daily chart. Okay, really simple framework. It's sound logic. It repeats. It does this a lot across all asset classes. It's not just a Forex one-trick pony. Okay, it's based on the logic of time and price. And even if you're looking at like indices, between 10 o'clock and noon, you're going to be looking for that window anyway to be exiting your indices, preferably closer to 11 o'clock, really. But in that time window, that's still viable for trading indices, not just Forex. Okay, if you are a stock trader, same thing, because stocks are going to work off of that morning swing and that afternoon swing with the typical New York lunch consolidation. Okay, so again, this is another example of how you can look at the things I'm teaching, how to visualize a trade framework, and how we would use PD arrays to build an understanding about what it is we're looking for, what would make a viable setup. And it's short-term in nature, so it allows you flexibility. You get into the same day, you get out. It's